After studying this module, you shall be able to know about the gold standard, understand the transition from gold standard to the Bretton Woods system and the collapse of Bretton Woods system, appreciate the types of exchange rate systems prevailing in the world today, know about the European monetary system, and finally, you shall be able to understand the difference between fixed and flexible exchange rate systems.
The set of rules, conventions, and institutions that govern the international business, trade, and investment are collectively referred to as International Monetary System. The International Monetary System provides the framework within which foreign exchange rates are determined. A foreign exchange rate is the price of one currency expressed in terms of another currency. The existence of an efficient international monetary system is essential for smooth conduct of international business. Its main purpose is to facilitate the transactions between different countries. This module gives a brief account of the evolution of international monetary system from the 19th century to the present day.
Let us now move to the evolution of exchange rate system. The international monetary system has evolved through various stages. Starting from gold standard in 1870s, it gradually moved on to the Bretton Woods system and then finally to flexible exchange rate regime in 1973.
Under this system, each nation allowed its currency to be converted into gold on demand, and there were no restrictions on movement of gold from one nation to another. Each country maintained gold reserves in order to back the value of its currency. The payments between countries were mainly settled by exchange of gold. If a country imported more than it exported, gold flowed out and vice versa. The gold standard facilitated automatic correction in balance of payment disequilibrium of a country. For example, if Germany had a trade deficit, meaning thereby exports less than imports, then gold flowed out of Germany for settlement of trade, leading to contraction in Germany's money supply. This pushed down the prices in Germany, making its goods cheaper and competitive. This in turn led to increase in demand for Germany's exports, thus wiping out the deficit.
The gold standard was abandoned in 1914 with the outbreak of First World War. During the war, the countries started printing money to finance the war activities. The countries restricted the free movement of gold from one nation to another and also suspended the convertibility of currency into gold. After the end of the First World, the countries started returning back to the gold standard. US became the first nation to adopt the gold standard back in 1919, followed by Britain in 1925. With the onset of the Great Depression in 1929, Britain started experiencing recurring balance of payments deficit. Britain's gold reserves were depleting at a very fast pace, and it became impossible for them to maintain gold standard. So, in September 1931, the British government suspended the convertibility and let the pound float. Many countries, like Japan, Austria, and Sweden, followed suit by the end of 1931. Investors started preferring gold to foreign currency dominated securities. This affected the US gold reserves adversely and led the US government to abandon the gold standard in April 1933. After the collapse of gold standard came in the Bretton Woods system or pegged exchange rate system. In July 1944, the representatives of 44 nations met at Bretton Woods, New Hampshire, to design a new international monetary system. Agreement was reached to establish two multilateral institutions, namely International Monetary Fund or IMF and International Bank for Reconstruction and Development. Each country agreed to fix the par value of its currency in relation to the US dollar. This par value determined the exchange rate between different currencies. The US dollar was in turn pegged to gold at $35 per ounce. US dollar was the main reserve currency held by central banks and the only currency that was directly convertible to gold. Each country was required to maintain the market value of its currency within plus minus 1% of its adopted par value. However, the member countries were allowed to alter the par value of its currency if it faced fundamental disequilibrium in the balance of payments. For changes up to 10%, IMF approval was not required. But for changes beyond 10%, IMF approval was necessary. Let us now move on to the collapse of Bretton Woods system. During 1960s, various expansionary programs were undertaken due to which its balance of payments swung into deficit. The member countries began to lose confidence in dollar and started converting their dollar reserves into gold. The gold stock with the US Treasury began to fall drastically. Due to recurring balance of payment deficits in August 1971, US suspended the convertibility of dollar into gold and also levied a surcharge of 10% on imports until the re-evaluation of other currencies against dollar. In order to save and restore Bretton Woods system, in December 1971, a conference was held at Smithsonian Institute in Washington, D.C. An agreement was reached to devalue dollar to $38 per ounce of gold from $35 per ounce. Currencies of surplus countries were revalued upward and fluctuation band was widened to plus minus 2.25% from plus minus 1%. The Smithsonian Agreement could not go far as the devaluation of dollar was not enough to stabilize the situation. In February 1973, the parity value of dollar was again revised upward from $38 per ounce to $42 per ounce. By March 1973, the major currencies were allowed to float and the Bretton Woods system came to an end. After the collapse of Bretton Woods system, IMF constituted a committee to evolve a new international monetary system. The committee members came out with a new set of rules which were formally accepted by all member countries in a meeting at Jamaica in January 1976. With this came the system of flexible exchange rates, where the exchange rate is not fixed by government authorities. Rather, it is determined by the market forces of demand and supply of the currencies in international market. Under the new exchange rate system, a country can choose from one of the following options: managed float system, free float system, crawling peg system, currency board arrangement, and target zone arrangement. Under the system of managed floating, a country's monetary authorities intervene directly or indirectly to stabilize the exchange rate and to keep it within desired limits. It is also known as dirty floating. Under the system of free float, the exchange rate is determined solely by the forces of demand and supply, and it does not involve intervention. This system is also known as clean float or independent float system. Crawling peg system is a hybrid of fixed and flexible exchange rate system. Under this system, the country establishes the par value of its currency in relation to a foreign currency or a basket of currencies and then allows the par value to change gradually. Under currency board arrangement, A country has a currency board which pegs the domestic currency to a foreign currency and allows the unlimited exchange of domestic currency for the foreign currency at the fixed exchange rate. The currency board is required to build reserves of the foreign currency equivalent to the amount of domestic currency it has issued. Under the system of target zone arrangement, a group of nations with common goals and interests agree to either maintain exchange rates within a specified band or to replace their domestic currency with the common currency.
Let us briefly discuss the different options under new exchange rate system that a country can opt. Managed float system. Under the system of managed floating, a country's monetary authorities intervene directly or indirectly to stabilize the exchange rate and to keep it within desired limits. It is also known as dirty floating. In case of direct intervention, the monetary authorities attempt to stabilize the exchange rate by buying and selling foreign currency in the domestic market. When it buys foreign currency, its demand increases and the domestic currency depreciates against foreign currency. When it sells foreign currency, its supply increases and the domestic currency appreciates against foreign currency. In case of indirect intervention, the monetary authorities bring changes in the interest rates to stabilize the exchange rates and flush out the excess volatility. Some of the countries which are following this system are India, Russia, Egypt, Singapore, Thailand, and Czech Republic. Free float system. Under this system, the exchange rate is determined solely by the forces of demand and supply, and it does not involve intervention. However, in practice, some intervention is found in the system of free float as well, typically to prevent any undue fluctuations in the exchange rate. This system is also known as clean float or independent float system. Some of the countries following this system are United States, United Kingdom, Japan, Switzerland, Australia, Brazil, Canada, and Mexico. Crawling peg system. This system is a hybrid of fixed and floating exchange rate system. Under this system, the country establishes the par value of its currency in relation to a foreign currency and then allows the par value to change gradually along with changes in the factors like inflation. A country can either peg its currency to a single currency or to a basket of currencies. Countries like Jordan, Bahamas, Iraq, Lebanon, Maldives, Saudi Arabia, and Qatar have pegged their currencies to a single currency. Countries like Fiji, Libya, and Morocco have pegged their currencies to a basket of currencies. Currency board arrangement. A country following this system has a currency board which pegs the domestic currency to a foreign currency and allows the unlimited exchange of domestic currency for the foreign currency at the fixed exchange rate. In this system, the currency board is required to build reserves of the foreign currency at the fixed exchange rate equivalent to the amount of domestic currency it has issued. With this system, the money supply can be controlled effectively because additional currency will be issued only if there are foreign currency reserves to back it. It also helps to keep check on inflation. The examples for this system includes Hong Kong pegged to US dollar. Target zone arrangement. In this system, a group of nations with common goals and interests agree to either maintain exchange rates within a specified band or to replace their domestic currency with a common currency. An example of this system is European monetary system, which was introduced in 1979.
Let us now have a look at the systems being used by different nations. Countries like India, Russia, Egypt, Singapore, Thailand, and Czech Republic have adopted managed float system. Countries like United States, United Kingdom, Japan, Switzerland, Australia, Brazil, Canada and Mexico have adopted free float system. Countries like Jordan, Bahamas, Iraq, Lebanon, Maldives, Saudi Arabia, and Qatar have pegged their currencies to a single currency, whereas countries like Fiji, Libya, and Morocco have pegged their currencies to a basket of currencies. Countries like Hong Kong and Estonia have adopted currency board arrangement. And the example for target zone arrangement is European monetary system. Now we shall learn about the European monetary system. After the demise of Smithsonian Agreement, 6 Western European nations agreed to maintain the parity values of their currencies within a band of plus minus 1.125% as against plus minus 2.25%, described in the Smithsonian Agreement. This system came to be known as snake. The snake could not function smoothly for long. In order to bring greatest degree of stability and to deepen the economic integration between the member countries, the snake was replaced with the European Monetary System or EMS in March 1979. The European Currency Unit or ECU was also established in 1979. ECU was created as the weighted average of the member countries' currencies. The EMS was based on parity grid system where the exchange rate between any two currencies was determined on the basis of their weights or share in ECU basket. Due to differing economic conditions and policies of member nations, the parity grid experienced serious damage. In September 1993, the band for fluctuation was widened to plus minus 15%. In order to address the recurring problems in EMS, the European Union members met at Maastricht and signed the Maastricht Treaty in 1992. The member countries agreed to replace their individual currencies by a common currency by January 1, 1999. The European Central Bank (ECB) was established in 1998 and it works in conjunction with the national central banks to achieve price stability. In January 2002, euro notes and coins were issued, and by the end of February 2002, local currencies were completely replaced by euro.
During the initial years, a number of adjustments were made in the European monetary system. But due to differing economic conditions and policies of member nations, the parity grid experienced serious damage. In September 1993, the band for fluctuation was widened to plus minus 15%. So, in order to address the recurring problems in EMS, the European Union members met at Maastricht and signed the Maastricht Treaty. The member countries agreed to replace their individual currencies by a common currency by January 1, 1999, and also to harmonize their fiscal, monetary, and exchange rate policies to achieve greater convergence. The member countries were required to meet the following three criteria. First, to keep the fiscal deficit to GDP ratio below 3%. Second, to keep the government debt to GDP ratio below 60%. And finally, third, to achieve high degree of price stability. The European Central Bank, that is ECB, was established in 1998 and has its headquarters in Frankfurt, Germany. It works in conjunction with the national central banks to achieve price stability and is also responsible for a smooth conduct of monetary policy. Finally, on January 1, 1999, Euro was created and 11 out of 15 EU countries gave up their national currencies and adopted euro. These 11 countries were Austria, Belgium, Finland, France, Germany, Ireland, Italy, Luxembourg, the Netherlands, Portugal, and Spain. The EMS became the European Monetary Union (EMU). In January 2002, euro notes and coins were issued, and by the end of February 2002, local currencies were completely replaced by euro.
Now, we shall learn about the difference between fixed and flexible exchange rate system. In fixed exchange rate regime, the exchange rate is determined by the government, whereas in flexible exchange rate system, the exchange rate is determined by the market forces of demand and supply. In fixed exchange rate system, the exchange rates are periodically adjusted by the government to keep them in line with the changing macroeconomic variables, whereas in flexible exchange rate regime, the exchange rates adjust automatically to the changes in the market factors. In fixed exchange rate system, the government needs to keep large amount of reserves to maintain the exchange rate at the desired level, whereas in flexible exchange rate, there is no such requirement. In fixed exchange rate system, the exchange rates are fixed and stable but may lead to market distortions in the long run. On the other hand, in flexible exchange rate regime, the exchange rates fluctuate but remain stable around the equilibrium in the long run. Let us now summarize what we have learnt in this module. International monetary system is a set of rules, conventions, and institutions that govern the international business, trade, and investment. Gold standard was the first internationally accepted exchange rate system in which the currencies were pegged to gold. It was abandoned during the First World War. Attempts were made to restore it, but it finally collapsed in 1930s. Bretton Woods system of fixed exchange rate was established in 1944. US dollar was the reserve currency and the only currency convertible into gold. All other countries were required to fix the par value of its currency in terms of dollar. It finally collapsed in 1973. Flexible exchange rate regime was established in 1973. The countries can adopt any of the following systems according to their macroeconomic fundamentals. The various options are managed float system, free float system, crawling peg system, currency board arrangement, and target zone arrangement. European monetary system was established in 1979. Euro was adopted on January 1, 1999. Fixed exchange rate system differs from flexible exchange rate systems on several counts like determination, adjustment of balance of payment deficit, and requirement to hold reserves.
Let us now recapitulate what we have learned in this module. International monetary system is a set of rules, conventions, and institutions that govern the international business, trade, and investment. It defines the framework within which the exchange rates are determined. First, internationally accepted exchange rate system was the gold standard. Under this system, the currencies were pegged to gold and two-way convertibility was guaranteed. This system contained an automatic mechanism for correction. Gold standard collapsed during the First World War because the countries suspended free convertibility into gold. After the war, it was readopted by countries, but it could not go on for long due to the Great Depression in 1929. So it was finally abandoned in the 1930s. The Bretton Woods system of fixed exchange rate was established in 1944. The agreement also established two multilateral institutions, namely IMF and IBRD. Under this system, US dollar was the reserve currency and the only currency convertible into gold. all other countries were required to fix the par value of its currency in terms of dollar. A fluctuation band of plus minus 1% was established. However, for significant changes in the par value, IMF approval was necessary. In 1960s, the US experienced severe balance of payments deficit due to which the US dollar stood overvalued. Attempts were made to prevent the collapse of Bretton Woods in the Smithsonian arrangement, but the arrangement could not go on for long, and the Bretton Woods system finally collapsed in 1973. Since 1973, the floating exchange rate regime was adopted by countries with following options: managed float system, free float system, crawling peg system, currency boards arrangement, and target zone arrangement. Different member countries have adopted systems that suit their own convenience and their macroeconomic fundamentals. 6 Western European nations agreed to maintain parity values within a fluctuation band of plus minus 1.125%. This system was known as SNAKE and was replaced by European Monetary System in 1979. European currency unit was established as the basket currency, and the exchange rate between any two currencies was determined on the basis of their weights in the ECU basket. Finally, in 1992, the countries signed an agreement to adopt a common currency by the end of January 1999. Fixed exchange rate system differs from flexible exchange rate systems on several counts, like determination, adjustment of balance of payment deficits, and requirement to hold reserves.